Hi, it's John, and I'm pleased to be here today with you and a great guest from Singapore. It's Steven Pearce, who is the founder and managing director of Diverse Capital and a related company called Reverse Takeovers. And I'd like to welcome Steven here to tell us more about what he's up to. Hi, Steven.
Yeah, good afternoon, and thanks for having me. So, I guess originally from Australia, from Perth, Western Australia. So, guess spent the last 20 odd years in the capital market space. The last 16 years of which been working overseas. So, I guess I started my career in the late 1990s, just before the tech crash, which was a pretty good foray, I guess, into the capital market space. Working with a couple of stockbroking firms out of Perth on their derivatives and equity desk. So I guess I've seen the ups and downs of leverage over the years, and obviously in the small cap space, seen quite a few deals over the years. So I guess my other working career, I left Perth in 2004, spent about 3.5 years in London in the UK. That was working with some of the bigger investment banks over there, being Deutsche and Merrill Lynch. So yeah, quite a few good years in London. Obviously, the weather is always one thing that you need to deal with, but otherwise, yeah, great place in the world. And I left London in 2007 and then moved out to the Caribbean, actually. So I spent nearly 5 years in the Cayman Islands. That was working for an offshore broker, so it was mainly trading US and Canadian equities, but also guess we did also trade FX, fixed income, and commodities. So quite a bit of a mix. I was lucky enough to be involved with a couple of listings in Canada around 2010, and they were actually listings on the TSX venture. So yeah, junior companies, obviously, it's about getting some growth capital behind them and scaling them. So that was quite good. And then, moved out to Singapore in 2012. So been out in Singapore for the last 8 years, the last 6 of which been running Diverse Capital. So.
And I think that's what would be really helpful to dive right into then, Steven. Can you tell us what exactly you're doing with Diverse Capital? Because you mentioned a few hints around helping to raise funding through public markets at various points in your career, the Canadian markets,
Yep.
But you're in Singapore, a long way from there now, and not many people know exactly what Diverse Capital and Reverse Takeovers is all about. So can you give us the short and sweet about it?
Yeah, sure. So, as I say, the last 6 years been running Diverse Capital here in Singapore. We're focused on assisting growth companies with their public listing needs. So I guess I've been lucky enough to be involved in about 6 listings on varied exchanges. So 3 on ASX. I was involved in a listing in Singapore here a number of years ago. Last year, a listing in Switzerland and on the SIX exchange, and more recently, just earlier this year in 2021, involved in a listing on the TSX, sort of where we got involved. But essentially, we hold the hand of the target company that we're looking to list, and once mandated, we assist the company with pre-IPO funding and also funding at listing. But I guess coupled with all that as well, we assist in structuring the deal. In the event of a reverse takeover, we line up the right shell. Obviously, also there's quite a bit that goes into a listing. So order exchange, board composition, investor relations, public relations, lining up independent research once the company's listed, and dual listing are all obviously things that need to get dealt with along the journey. And that's where we, obviously assist the targets with those sort of duties. So pretty varied, but I guess at the end of the day, we leverage off 20 odd years of relationships globally. So.
Well, exchange listing is a huge topic, but maybe to give some grounding to this, I wanted to throw the question at you. Can you give us an idea of the landscape of, the major markets people are probably more familiar with, like the NYSE and the NASDAQ, as well as, international ones like LSE? What type of markets are you working in, and where do those fit into the global landscape?
So the 2 main markets that we deal with are traditionally Australia being the ASX, and in Canada, the TSX Venture. There is a number of other junior exchanges being the CSE, or the Canadian Securities Exchange, and also the NEO in Canada. But typically it'll predominantly be either CSE or the TSX Venture. So I guess with that, we sort of target similar companies. So we've got a focus typically on Series A round companies where obviously they're private at this stage, but they're looking to go public. So instead of going the traditional VC route and seeking private funding, that's where we'll get involved, get mandated, and obviously assist them to raise the capital to get to market. So I guess with that, there's the sort of targets that we look for. We like to see companies with revenue, so they don't need to be profitable, but we do want to typically see at least a couple of million of revenue on an annual basis. We also like to see companies that have had a minimum 1.5 to 2 mil of external funding. So obviously friends and family are sometimes obviously part of the initial capital, but we do like to see some other external shareholders participating in early rounds. We also on the tech side like to see companies where they are monetizing and the tech has been built out. So anything that's pre-revenue is probably too early stage for us. And we do like to see companies where they're growing, say at the top line, or if it's user numbers, whatever the metrics are. We do like to see quarter-on-quarter growth. So I'd say that if the company was going sideways or seeing a decrease in either revenue or user numbers, that's typically not the sort of company that we like to get involved with. I guess there's a few other things that are important. Obviously, solid teams and management. Obviously, that comes to execution of the growth strategy for the company. We like to see stories where there's a global story or large blue sky. So obviously, with additional growth capital, the business can really be scaled. Obviously, those hockey stick growth curve companies are obviously companies that investors like to back. We also, I'd say companies where their burn is out of control. So where, I guess insiders are, taking large salaries, that's obviously a red flag for us. And obviously, like to see companies where, they are keeping that burn to a minimum. So all the raised capital does go straight into the business. I guess investors never, like to see, monies getting raised by the company and then it going out the back door. So yeah, that's, I guess, a couple of high level.
So Steve, I want to go back to the topic of Australia and Canada in a little bit more detail in a moment, but you were speaking to, what type of companies you look for and fit into the public markets route. But can you talk a little bit in more detail about the trade-offs that come with deciding to list publicly versus, for example, raising funds through a venture capital route?
Yeah, for sure. I guess I'll start with the considerations. I guess, with public listing, obviously there's a number of considerations. And obviously management time. So, it isn't an easy process for management to get listed. Obviously, audits is always one big thing that always slows things down. But, I guess there's a trade-off between focusing on the public listing and getting it to market versus obviously focusing on the day-to-day business needs. So that is something that management and obviously directors need to consider because it is a huge task. I guess some of the other considerations with going public are the ongoing costs. So obviously you've got obviously disclosure and corporate governance that needs to get adhered to. Obviously, that's all part of the ongoing costs in putting the right teams in place to address all those needs. There's a couple other, I guess, things to consider. Obviously, once you're in the public domain, I guess the spotlight's on the company and management. So, I guess you could say that there's more pressure on management to perform. When you're a private company, essentially, you're not in the same, public domain and scrutiny. So that's definitely one thing to consider. There is also other considerations. I guess, civil liability is always one thing. Obviously, misrepresentations is always, in the public arena, probably something which has got greater consequences than sometimes in the private domain. But I guess, but both situations aren't ideal. And then there's obviously, tax considerations, especially when you say rolling your company into, say, a shell company. There's obviously potential tax considerations that need to get considered. So I'd say they're the main considerations. In terms of why you should list, there's obviously a number of benefits. I'd say that generally access to capital is one big thing. So once you're publicly listed, the ability to raise further capital is definitely easier. So you can typically raise capital in a 24 to 48-hour window once you're publicly listed and you've got supportive brokers. Obviously, with the private route, can take sometimes months, 3 to 6 months, depending on the round of financing. There's also a few other benefits, definitely around liquidity for existing and future shareholders. So obviously also the ability to I guess, bring in employees into a public company through ESOP pools, which is your employee share option plan. They're obviously looked upon more favourably when you're a public company as opposed to employees receiving shares in a private company. So, there's price discovery there or transparency. So I'd say also there's company, obviously, you've got a greater level of credibility compared to maybe a private company. So your ability to do business with other companies and partnerships is somewhat easier. Also, obviously, equity is compensation for management. Again, there's flexibility there. And obviously, with mergers, and liquid stock, obviously, there's obviously getting employees to come on board is somewhat easier. Also around borrowing, maybe as a public company, typically I'd say the ability to borrow is maybe somewhat easier. And obviously the method of valuation, typically in the public markets, obviously the valuation for companies is typically higher. Some might argue with the VCs at the moment, but I'd say that generally speaking, if you're a private company versus a public company, you'd definitely have a higher valuation in public markets. So yeah, that's probably a bit of a high level helicopter view. Yep.
You made a lot of very good points there, Steven, and I think those, especially from the financial world, would appreciate the structure and the history of capital markets, and also I think that there's a lot of excitement around venture capital and also a lot of failure involved, like with any business venture. So if I'm an entrepreneur or a company, CFO who's at the point where we're getting serious about our business and I've decided that public markets are something that would interest us, why is it that I should be thinking about international exchanges to list, and in particular the Canadian and Australian exchanges? Can you tell us more about that?
I'd say that both Canada and Australia are prepared to back early stage companies, which obviously have a good growth story. I'd say that some of the countries, for example, here in Singapore, a lot of the appetite is probably less. There's a focus more on yield. Commercial property and residential property is definitely an investment theme here in Singapore. So, potentially the appetite for earlier stage companies is less here compared to, countries like Australia and Canada, which have a greater level of appetite for risk. I'd say also just with Australia and Canada, both of them have a pretty solid regulatory regime. So, yeah, I'd say that they're definitely ideal places for early stage companies to list. Yeah.
Well, and maybe looking at some of your deals, and in particular the regulations around the venture market in Canada, you've mentioned to me the capital pool company concept, and that's not something even I, as a Canadian and finance expert, was terribly familiar with. Can you go into some more detail and explain to our audience what that's all about and why it offers some great opportunities for your clients?
Yeah, for sure. So just before I guess we go to the capital pool program, obviously, a topic in the market at the moment is obviously these SPACs in the US, which is essentially a special purpose acquisition company. So obviously, there's been a huge amount of activity in the merger and acquisition space this year with SPACs. somewhat similar in Canada. They've got a program called the Capital Pool Company Program. So it's a CPC program. What that is essentially it's a shell company. You typically go and raise $100,000 at a 5 cent level in the shell. That's typically the seed round to get friends and family and founders set. And then typically what you do is you raise anywhere from $200,000 through to $4.75 million. And that's normally done at the 10 cent level. So what you find is a lot of these shell companies, they'll go and raise the minimum, being 200 grand at 10 cent level. And that obviously, that's done to give the shell the spread or the shareholder names. So typically you need at least 200 who each buy at least 1,000 shares. So what that then gives you is typically a shell with at least a couple of hundred grand in cash. You've done your seed raise at 5 cent level. You've done your broker round typically at 10 cents, and then what you've got 48 months, to then find a target business to then inject or to merge with. So typically, these CPCs, they're listed on the TSX Venture. They're obviously, they're trading, but they're sitting there looking for a deal. So within that 48 months, typically they'll do a deal with a target. Then they'll agree the valuation with the target, and then the target will then be issued shares in the consummated entity. So obviously, it's quite it's a well-trodden path, I guess, for growth companies. It's quite an interesting path, definitely, for companies. Instead of going to an IPO and then having to find 200 shareholder names, obviously the CPC gives the spread requirements. Obviously, there's things that need to be dealt with along the journey to make sure that the qualifying transaction is completed. Obviously, you've got a filing statement, a circular that needs to be prepared. Obviously, the TSX Venture then need to look at the filing statement, ensure that obviously the minimum listing requirements are met, being spread. Obviously, you also need to see typically 12 months runway or capital for the target. And then obviously once those conditions precedent to the deal are met, then obviously the deal is completed, and obviously then the consummated entity will trade on the market. So definitely interesting that the ASX in Australia, they don't have obviously the shell program. So the bar to list down in Australia is somewhat higher. You need typically $4 million of net tangible assets for a listing down in Australia. So I guess, for Canada, there is a program for earlier stage companies to list. I guess one final point as well with listing in Canada is you can actually also do a listing without having to raise capital at the IPO. So essentially, you can do a non-offering prospectus as long as you've got 12 months runway. Then you can actually go to market without having to raise fresh capital. There is a few benefits definitely with Canada.
Very unique. That was helpful. Thank you, Steve. Are there other points about how your model works that you want to mention before I move into some final questions?
Obviously aligned 100% with the target. Obviously, our model is obviously receiving a small retainer fee, but otherwise, most of our compensation is from equity at the consummation of the deal. So obviously that aligns ourselves with the target, and if the target receives 2 to 3 years of escrow, then we receive the same typically as well. I guess just going back to the CPC program in Canada, a couple of stats that may interest viewers out there. I guess since inception, there's been 2,600 plus CPCs. It's definitely a well-trodden path. Of those 2,600 plus CPCs, more than 85% have actually then completed qualifying transactions. And with that, over 75 billion has been raised by the former CPCs. So definitely a large amount of capital raised through the CPC program. I think also worthy of note is for 32% of the current Toronto Stock Exchange main board listings are actually former CPCs. So that's quite a decent stat.
I had no idea. That's actually excellent that you brought up the success rates of this path, because I think that's something that everybody will be asking. Is this something that proves to be successful, or is it the graveyard of good ideas? What I really wanted to start to narrow in on, Stephen, is if we're looking at, in particular, a fintech audience and investors around the fintech space, what's your pitch to them? Why is this something in public listing in general that they should be thinking about and paying attention to?
I think it's pretty obvious that there's definitely a large number of fintech companies that are going to public listing. You've seen a lot of success companies. I think even just a week or so, you had a firm list in the US, which is a fintech play. Obviously, with that, there's been some huge valuation uplifts from private rounds. So I think, with the great amount of liquidity that's out there in the markets at the moment, these fintech companies are tapping, those capital pools, and obviously with that, they're funding, the next 2 to 3 years of solid growth. I guess with that, obviously, the valuations don't just benefit the founders and the insiders. Obviously, for shareholders as well, it gives them, obviously liquidity with their shares, and obviously with that, they're seeing huge uplifts. And obviously, public market space in general is a great way to supercharge the growth of these companies, which obviously some of them are extremely capital hungry, but in some cases it's a bit of a land grab. So while the capital is there, obviously they're taking advantage of that. So yeah, a couple of points there to consider.
I guess maybe a bonus question. How do you see the ICO space? That's something that had its moment a few years ago and then has pretty much disappeared. Are you waiting to see what develops there with things like the crypto exchanges or digital asset exchanges that have popped up here in Switzerland, for example, but I'm sure also in Singapore? Do you have any quick thoughts on that?
Yeah, it's generally not something that we focus on very much, actually, because there's a few issues. For example, in Australia, any private company which has got an attached ICO to it, obviously there's typically greater scrutiny for the companies which have had an attached ICO. So, there's obviously some tax issues there that some of the bosses have sort of shied away from. In terms of obviously the ICO space as well, obviously there's been some issues around KYC and AML, and obviously some use of funds which have not been ideal, where ICOs, large amounts have been raised, and potentially the funds haven't been utilised the way that they've been projected to the market. So yeah, it's generally not a space that we get too involved in. Yeah.
I've had some similarly pessimistic and realistic comments about ICOs over the years, and it's been interesting to watch all that's gone on. I mean, huge amount of money raised, but also all kinds of nonsense around it. So I hope to see the dust clear and more value tangibly being created in that space. Steven, this has been a lot of fun. I wonder if you have any final messages for our audience to keep in mind, and especially where they can reach out to you to do some more business with you.
Yeah, I guess my sort of parting comments were that, over the last couple of years, been involved with a couple of successful transactions. The last ASX listing that I was involved with, there was a company out of Adelaide. It was in the technology welding space. What we liked, I guess, about the company is they'd raised about 5 million before we obviously saw the opportunity. The technology had been de-risked from the CSIRO, which is the scientific institute down in Australia, and obviously had a solid board and team. They just needed additional capital to grow. So along the journey, there was a pre-IPO round, 1.3 million done at 13-cent level, and a further 5.6 million was raised at 25-cent level just in September. I guess 4 or so months ago. So that company has now had about 14 million raised. Obviously, as a consequence of that, they're now growing across the US and Europe, and at a 39-cent share price today, the company is now trading at about a 60-odd million market cap. So I guess from listing at about 25 mil through to today, they've seen pretty decent uplift in terms of their market capitalization, and obviously shareholders as part of the journey have done pretty well. And I guess the more recent listing that I was involved with that we put together in Canada on the TSX venture, listed on the, it's called Banksa. It's actually in the crypto payment space. So it's more of a payment solution around the fiat onboarding or fiat to crypto onboarding. So they link in with some of the exchanges. That company has raised previously about 5 million. So we assisted in getting them to market. We lined up the shell company in February of last year. Obviously, at listing, their market cap was around 50 mil, and then today, they're close to about 100 mil market cap just in the last couple of weeks. So, for shareholders and insiders, they've seen their stock double, and obviously, we're now helping them with a dual listing into Frankfurt and a dual listing into the US on the OTCQX. So. There's obviously reasons for that. Obviously, as the company grows, it'll need more capital, but it's about also giving other investors in those markets opportunity to trade the shares in their home currency. So that's obviously one thing with growth companies. If they can do a dual listing in other markets, obviously they can supercharge their growth. And obviously investors always want to trade shares in their home denomination or currency. So so definitely that's a couple of successful cases over the last few years, and obviously with that, always happy to chat to other targets if they're considering public listing. So.
Excellent. Well, yeah, I was going to say that it's always good to have a track record of shared success. That's its own best advertisement. So thank you for sharing that to wrap things up, Steven. What's the best place to reach out to you and find out more information about your work?
So I guess a couple of websites. So reverse-takeovers.com. So on that website, you'll see myself, and you'll see a profile of a gentleman called Konstantin Lichtenwald in Vancouver. He's my North American partner, so he sits on 3 or 4 boards in Canada. Obviously, if you go to that website, you'll see Konstantin's profile there as well. So we can, obviously line up shell companies for targets and obviously assist with a whole listing in North America. And then obviously for Australia, obviously work with a number of brokers down there. So the other website, which is my Singapore entity, diverse-cap, so -cap.com. So a couple of websites there. Maybe at the end of the presentation, we can note those domain names for people to.
Of course, yeah, we put them in the description with the video. So thank you for also listing them, Steven.
Okay.
And thank you for all the insights today. I'm curious to see your next deal, and we'll be sure to check out Banksa. It's been probably a great time with crypto prices for them to be doing business, crypto payments, and continued success with diverse cap and reverse takeovers. Thanks again.
Thanks a lot, John. Yep, appreciate your time. Okay, thanks very much.